Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 308th VideoCast podcast for the week ending September 11th, 2025. Got a lot of incredible stuff to cover this week, but as always, family first. This is a picture with the family this weekend at dinner. Caitlin, Annabelle, Mimi, and me. Same view. So we're going to kick off water polo season very soon and swim season very soon, so we'll have a lot more sports updates. Right now they are in practice mode. Also want to thank Zach Hoang for recording this incredible video trailer and just kind of gave it to me as a gift. He's been a long time listener and follower. I actually believe I went to his school. He studies with Statman when I went to La Quinta and spoke to the senior class there and had a wonderful time earlier in the year. I think it was super early this year or late last year, right when we had moved here. And he put this together to me, so I want to share it with you. I thought it was absolutely incredible. Take a listen and look here.
Joining me for more on this and everything moving markets, or that could potentially move markets today, is Thomas Hayes.
Tom Hayes. And Thomas Hayes.
Co-host Thomas Hayes. Tom Hayes joining us this morning. Thomas Hayes.
Thomas Hayes.
Thomas Hayes.
Joining me now is Tom Hayes.
Thomas Hayes.
Tom Hayes.
Thomas Hayes.
Tom Hayes.
Great Hill Capital Chairman Thomas
Welcome
Hayes.
to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your second weekly
How many
recap.
different ways can we say
10th
tomorrow's
episode of the
newspaper today? Welcome to
VideoCast.
Hedge Fund
This
Tips
is
with Tom
Sell the
Hayes.
Rumor by the News, ladies and gentlemen.
So wide you could eat a banana sideways.
3 bananas sideways, eat a watermelon sideways. 200 VideoCast.
And I think I said history doesn't repeat, but it often rhymes.
300 VideoCast.
Burden yourself with the facts.
Burden yourself with the facts. The number one podcast in the hedge fund category. Well, there you go. Thank you so much, Zach. Stephen has been doing an incredible job for us for many years. So Stephen's going to keep going. But if you need video work, reach out to Zach Hoang. Here is his handle on Twitter, and I'm sure we'll be doing some projects with him, and really, really grateful for that. And it couldn't come out a better week with all that's been happening with Cooper Standard and Baba and all the others. So super excited for that. I want to thank Stephen Nellis and Aditya Soni for including me in their article on Reuters. Some quotes of the week. Peter Lynch: when stocks are attractive, you buy them. Sure, they can go lower. I bought stocks at $12 that went to $2, but then later went on to $30. You just don't know when you can find the bottom. That's from Peter Lynch, legendary fund manager, Fidelity Magellan Fund. Bruce Kovner: through bitter experience, I've learned that a mistaken position correlation is the root of some of the most serious problems in trading. If you have 8 highly correlated positions, then you are really trading one position that is 8 times as large. And those clients know, obviously, seeing the incredible returns that we've had and the low correlation that we have to the indices has been a blessing, and then the bespoke individual positions, and then how we do the overlays. So super excited. And then Buffett: I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. And it's interesting. I think so many people apply this because they look at the indices every day and they say, oh, the market is high or the market is low. And what they totally miss is that on every given day, the market serves up prices, and we get to decide whether or not they're correctly priced, overpriced, or misappraised. And even in a market where the tape feels frothy, if you look at what's out of favor, defensives, which, by the way, are going to abruptly come back into favor, and we're positioned to take advantage of that as well. You'd be absolutely amazed the things that can be done on a daily basis, even when the market, and the problem is when the market is frothy, everyone crowds into the frothiest items within that, and that's how they get hurt over and over and over. They get FOMO, they chase the wrong things. and they're highly correlated. And here we do the exact opposite, as you know, as you've been following for so many years. And we're grateful for that support. And we're going to do more of it today. We've got an awful lot of stuff to cover today. I just want to give you guys a clue and understand why the smart money and the clients that have the most amount of money with me have been putting a lot more money with me. And the ones that don't have money are saying, when's the right time and this and that, but have been really lining up for October for sure. But I want to just kind of walk you through some of the names that we've talked about over months and years, and kind of like, if you step back and zoom out and understand where we are in the process, we're not chasing the Palantirs, we're not chasing the NVIDIAs, we're not chasing some of the ones that are at levels where I'd be very, very nervous every night going to sleep. We're in the ones that are just getting started. Now, you take a look at Advanced Auto Parts, which is up double off the lows in a few months. Sure, could it consolidate for 4-6 weeks before making the next move to 100? Sure, before it doubles again. But this is not a stock that you're buying at the top. This is a stock you're buying close to the bottom. Even Baba, look at this move from 64, actually 55, to now 155, beyond more than double, even now double off the basis. We brought the basis down to 82 and change. And by the way, it's unbelievable. We got a ton of options expiring in January that were spreads that we bought between 65 and 70 cents. And we were taking off, the max expected value on those is 7x. And we were taking off a ton, millions upon millions of dollars between 5.5 and 6x. So we could wait for the 7th X. But when you're up 450 to 550% on millions upon millions of minutes, you ring the register. Did we sell one single share? No. The move in Alibaba is just beginning. But it's so far past the spread of our strikes when we bought at 65 and 70 cents when everyone was puking in the hole, and now we can sell close to $4. You don't want to be a pig waiting for that $5 and then you get, a little pullback before January or whatever. And we have a ton left to get $4.50 and even $5. We'll have some that we just allowed to expire at max value of 7x. But if we're getting out at 6.25, 6 times our money on a huge, enormous position. And what's so unbelievable, it's not just being right in the right stock, because the stocks, that's great. We're up double. But the expression of how we do this is like all of the returns. If we were just buying 8 stocks and waiting, like, okay, that's great. We do better. We get our doubles and triples over a couple of years. It's not that. It's the secret sauce of what we're doing with the overlays that is generating huge amounts of return with very little amount of excess risk. And the amount of money that we've made in Baba with the move not even halfway done is just staggering. And we booked a ton of that, and we got a ton more to book between now and January. But we've got so many multiples of our money off the table just from what we've been able to harvest at not the full 7 times, but the 5.5, 6 plus times. The point that I'm trying to make to you, ladies and gentlemen, is if you follow a sound framework and you get and you're patient and you don't trade on margin, and for my clients especially that hung in there and are getting so unbelievably rewarded, you earned it. And that's what we say since the beginning is they don't give away multi-baggers for free. Okay, was it fun buying Cooper Standard at $5 and change and watching it go to $3.85 before going to 15, before dropping back to 9, before going to 25, before dropping back to 13, and now at whatever it is, what the hell is it? It's at almost $40 and on its way to 80 and beyond. But that's why you're rewarded, and that's why most people aren't. They buy things up like the shiniest objects, and then they miss a quarter and the stock's down 40%, and they did it on margin and they blow themselves up. And because they don't know what they own. Baxter, does this look like you're buying it frothy? Like if the market corrected 15% next month, my money is that not only would this not correct 15%, this would probably be up 20 to 30% because it's a defensive. And you can see it did the exact same thing in the early 2000s. It has these cyclical, dramatic flushes, uncertainty over healthcare, and then it works its way back up to new highs. And this will be a 4-bagger. And we've been loading it out. Look at, Cooper Standard, people are like, oh, it's too high. Well, deconstruct it. And you tell me if we get to, forget 18 million, which is what we hit every cycle for the last 45 years. If we get to 17 million shares, the thing earns $10 to $12. So, is a 10 times multiple too rich on $10, $12? That's $120 stock. What if it gets to a 20 times multiple like it did back here, 140? Oh, should I invest? The market's frothy. Depends what you're buying. Disney, we've had a huge move in there. We bought a ton at 85. So it's 120, 117. This thing hasn't even started. This is going to work its way to new highs. Streaming is profitable. They got a moat around their businesses, the parks, the cruises, the whole thing. Generac has had a double over the last couple of months. This is just beginning its cycle. This is going to go work its way back 200, 300 and beyond, and maybe back to new highs with what's happening with the data center business that we covered in recent weeks. Intel, we've gone through this. You think you're overpaying here? I mean, this is early days. We're going to talk a little bit about that this week. Government's going to force people to take stuff, implicit coercion to take Intel's 14A stuff and sign up for big orders. And you are going to see this thing back over 60, back over 100 and beyond as this thing works out over time. Small caps. Okay, now people are getting interested that it's just breaking out to all-time highs after this, cup and handle for all the technicians. Measured move implies another $90, so that would be 243. So 330 minimum, and this is just early days for small caps. We've been talking about it. All you got skeptical on me here when we were just buying everything under the sun, and now here we are breaking out to new highs. Same with regional banks. Everyone was chasing the megas. The regionals are just breaking out. You're going to see a huge amount of consolidation. PayPal, this thing is generating more cash than they know what to do with. This one is going to be another Alibaba where you get patient. Here, let's just pull it up again for the 87th time. You know what? We're going to skip commodities today. We'll do them next week because we got too many Ask Me Anything questions. But I want you to look at this. We went over it 1 million times with Alibaba, and I said, hang in there, ladies and gentlemen. Hang in there, ladies and gentlemen. Well, let me tell you where we are with Alibaba. Okay? We just broke through here. We just got out of denial. Now we are starting the parabolic move all the way back up to new highs with returning confidence. I'll show you the chart once again so you can see this. Okay, you had aversion. This is denial. And now we are into moving up here. Remember this? Boom, 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 boom. We are in the parabolic move stage. This is going to go well over $200, and everyone's going to start getting excited once there's a 2 handle on it. And we've already we'll have by that time made 6.5, 7x on our options. We'll be up 3x on our stock. And, not a bad day for the largest position by far in the portfolio, although Cooper Standard has moved so much that that's a huge position, not because of where it started, but, with 4, 5, 6, 7, 7.5x, that kind of stuff happens. So, so where are we with PayPal? Okay, everyone's super skeptical. Alex Chris is doing everything he said he was going to do and then some, but people can't wait. So here you are. You had your big breakdown. This is exactly where we are, ladies and gentlemen. Ready? We are in right here, aversion. Okay, we shot up to 90, anxiety, back to aversion. We're going to get to denial pretty quickly like we just got through with Baba, and then we're going to get to return confidence when we have the parabolic move. So new money comes in today, I'd be buying the shit out of PayPal. I'd be buying it till my fingers bled while everyone's saying, is the market too high? Should I sell my indexes? Should I sell my Mag 7? I don't know. I'm not your money manager. You go talk to, someone else. Okay. We do serious underwriting here, private equity in the public markets. If we wouldn't buy 100% of the company with 100% of our net worth, we won't buy one share. PayPal, there's nothing to think about with free cash flow. Stanley Black & Decker, okay? Oh, it's had this, 60% move off the lows. Okay, so what? Did the exact same thing in the early 2000s, big fake out we had in April. Now we're just getting started. We're going to work back up to new highs over the next couple of years. Housing, rates lower, the whole game. We've been talking about this. It's happening in real time, but it's early days. And it's like people are like, well, how do you put new money to work? There's nothing to think of. I mean, I can still buy VF Corp at $16. Are you kidding me? Like, how many shares can I possibly get my hands on? I got Brack and Darrell. This is going to be a 4-bagger plus on the stock, probably another 5-bagger on the options. I mean, actually, it's going to be more than a 5-bagger on the options. It's going to be an 8 or 9-bagger on the options because we were able to buy so many in the 12s, and the spreads that we did. Yeah, anyway, I just love this business. I mean, if I loved golf as much as I love doing this business, I'd be a scratch already. I got down to a 9.3, by the way. I hit my low index earlier in this week, and then the next day I went out and shot a 95 because my rib muscles are bothering me again. But we got a hyperbaric chamber. I'm all good. I'm going to go back out and shoot 82, 83 like I did last weekend. So anyway, mortgage rates. Here we go. What have we been saying? By the end of the year, 30-year fixed below 6. Well, where are we? 628, and we haven't even got the cut yet. What about these option arms? They're now 562. Ladies and gentlemen, this is the game is very close to being on. ETF market share, U.S. small caps, record lows going back 30 years. This game is just getting started. Hiring well short of expectations. We know the million revisions now. What a complete train wreck. I can't believe that stuff happened. I mean, those people should be hunted down. Anyway, it's sad. But new leadership is coming. We're going to get better numbers. There's always going to be revisions, but that just was absolutely egregious. Can you find the trend? Jobs created, so it continues to go down. Mainland China margin debt levels versus market cap, just getting out of the gate here, not yet massively elevated. S&P 500 quarterly year-on-year EPS growth relative to consensus expectations. $11 versus $4. Earnings growth expectations for next quarter is 7%. So we'll see where it comes in, probably greater than double digits again. By the way, biotech just getting started here. I mean, this is exciting. This has been consolidating for 2 years. This looks like it's just $5 away from denial. Once we get up to 100, 105, we're right here, denial. And then we get our parabolic move and people say, what happened? And all of a sudden, everyone that bailed out down here we'll be jumping in at 130, 140, and we'll just be laughing all the way to the bank. AAII net bulls, unprecedented bearishness despite all-time highs. That's from Fundstrat, which, that's kind of interesting. Okay, next. Falling construction spend lead equals recession signal. That's interesting. That's not always the case. You had a similar thing in 95. You had a similar thing in 2001, right before you took off. So I kind of like it. I think they're misreading this. Equities as a share of household assets, US is 49%, China is 9%. This is going to shift dramatically. China is going to be accelerating more and more. Russell 2000 breaking out. Transports breaking out. Speaking of transports, I keep looking at UPS. We haven't done anything yet, but that's interesting. And we don't have full conviction yet, but man, I mean, there's just so much to do. Target, UPS. Looking at Starbucks because coffee prices are going to come down and their margins are going to go up, just like Hormel, the meat prices are going to come down and their margins are going to go back up. Restaurants are getting hurt because of meat prices. All those stocks are going to absolutely double and triple. There's so much to do in restaurants. I'm like a kid in a candy store, and everyone's wondering, should I buy the index? Should I sell the index? I don't know what you should do. We buy individual companies here at Hedge Fund Tips with Tom Hayes. All right. Change in something tells me that piece is going to go viral. Change in sector weighting since 4/8. You could see here, everyone's dumped out of healthcare and staples. These are going to get bid when you see a little volatility in the market, which you will. We're positioned for it. We love it. Medium age of all hope buyers is now 56 years old, up from 31 in 1981. You can't make this up. That's going to change very, very quickly. Diverging path. Profitable small caps have outperformed their money-losing peers this year. That's common sense. Total infrastructure investment spend needs $68 trillion. Margins continue to improve, back up to 11.3 from a 7% trough in 2021. 4-year cycle. These are the years that we tend to do extremely well when there's a lot of turmoil, whether it was buying the lows in tech in October 2022 and March of 2023, or COVID, or this year in April. So the third year of the presidential cycle tends to have volatility. That's where we just absolutely crush it. So we're excited to get into that period. Dollar stores have outperformed NVIDIA in 2025, by the way. That was those were names we were talking about when they were really beaten down in April. Fallen job openings. So yeah, they got to get on with the cuts, hopefully a 50, but more likely a 25. Nixon analog. What's this about? Oh, this is Hartnett being bearish. Value and small caps outperformed in the 1970s. Okay, so he's using this as an analog, talking about the easing and then what happened with value, small caps, REITs, commodities, real estate. I do think this is a good analog. This is also a similar analog that we saw from 2001 to 2006. And in this period, actually, tech started to underperform. So I do think there's something to be said there. Here is U.S. equity inflows still dominating year to date. China, big move. So China has got the most performance, 3-1 over the U.S., and they have the least inflows. It's like the money is just going to be cascading there. Once you get the Xi handshake, if you think the move to 155 was exciting, wait till you see what happens after this. It's like we said, you can only hold a beach ball underwater for so long. And kudos to those of you who kept the faith, who kept tuning in, who hung in there, who bought more in the hole when we were just buying till our fingers bled. Half of you are calling me and giving me money to manage, and the other half of you have retired on an island. I mean, or whatever. But anyway, market typically rises when Fed resumes cutting alongside a growing economy. We agree. Athletic apparel stocks, Lulu, Nike, VF Corp, they've all been weak. These are going to absolutely rip higher. The reason we don't own Nike and not taking a serious look at Lulu is because we have VF Corp. The reason we have VF Corp, it's a huge bet on Bracken, who had the 28 bagger at the Logitech turnaround, is doing an incredible job doing everything he says. And he had a lot more outs. He had the Supreme, which helped delever the balance sheet. He's got 5 other brands, a lot of things he can buy and sell in this environment, and he will. And we don't want to be correlated, going back to the Bruce Kovner quote. So over-correlated, we've got our exposure in that group. Keep looking at Dow, haven't done anything yet. Keep looking at Centene. They just have too much of that Medicaid exposure, but it's interesting at these levels because it's pricing that it's like going out of business, and it's not. Seasonality of September. You tend to get a bump early, a little volatility at the end before the year-end rally. This shows September versus the rate cut. Contrary to consensus, we think September is going to be an up month, and that's because the Fed's been on hold all year and is going to cut for the first time in September. That's only happened twice in the last 50 years, and markets did well both times. So you see the cut starts. This would probably be the better analog, which was 2024, the cut starts and you get follow through. Car dealership guy, automaker winners and losers in August. You see a lot of these guys. Toyota up 14%. Honda, Ford is up. SUVs, crossovers, and hybrids continue to carry the market. Household leverage is at a 50-year low. This is unbelievable. This $35 trillion of trapped equity HELOC game is going to be on. That's going to be consumer mania, restaurant mania, housing mania. And these haven't even started. Russell large cap value benchmark is close to a record discount to growth by PE ratio going back to when? 2021. This is going to be so much fun the next 5 to 7 years. We're going to make so much money. It's going to be insane. If, by the way, most of you are already smiling, so why do you could eat 4 bananas sideways this year? I mean, borrow my glasses. What's going to take place in the next 5 years is going to be unreal. And okay, Fed cut equals expansion. That's fun strat. Here's what the period we're in right now, kind of bouncing up to the high end of the range, get a little bit of consolidation, year-end rally. That's normal this time of year. So next couple of weeks, we'll be talking about that consolidation. Those of you who have new money in will be able to take advantage of that. Russell 2000, small cap flows just beginning. You can see here as it's breaking out to new highs. Mainland China capital inflows into Hong Kong stocks have reached 1 trillion Hong Kong dollars so far this year. Divide that by 8, 150 billion. That's exciting. Speculators are net short across U.S. stock futures. Yeah, that's unreal. I mean, that's why it's hard to say we're going to like see any meaningful pullback in September and October beyond, normal garden variety 5 to 8%, which I don't even think you'll get as much as that because people are just so skeptical and they missed so much. So they're going to have to buy the unmagnificent 493 they're going to have to buy every single weakness into year end. Elevated pipeline of deals with issuance, performance of buyback aristocrats versus equal weight, gross and net buybacks. Look at this Russell 2000 just getting ready to break out again. And when they break out, it's usually multiple years, not weeks or months. Large stocks haven't always dominated the markets. You can see the cycles. We've done this international versus US. Small, you can see here the biggest rally in the shortest amount of time from 2000 to 2006. This is where we are, ladies and gentlemen, in my view. You see it in the 70s. You also see it in the early 90s, which is mid-cycle, which we've been saying we're probably mid-cycle another 9 years or so till 2030 to 2034. Until the millennials age up to early to mid 40s and their spending slows down. Alibaba's short interest declines after new chip report. Shorts getting squeezed left and right. European and UK value stocks are now ahead of the S&P 500 over the past 1, 3, and 5 years. How do you like that? Early industry gains drove the largest productivity booms. Today's productivity is historically low. That's going to help regular businesses. All this AI stuff, wait till you see how it applies to the most boring businesses in the 493, and your minds are going to be blown. With all the flows into China, with all the move in China, you can see here it's just now breaking out of this long cup and handle. Short interest is just rolling over. Emerging market stocks traded highest level since 2021. We've been pounding the table on that for a while, 2 years now. Now we look like everyone's saying, "Wow, great job." Down here, people were saying you don't know what you're talking about. Said the dollar was going to weaken. People said, you don't know what you're talking about. And those of you who tuned in every week knew what we were talking about, and you've reaped the benefits. BLS erases 911,000 jobs in largest revision on record. That's unbelievable. This is the largest revision on record since the Obama administration, 2009 and 2010. Alibaba Hong Kong stock price and net flow from southbound Stock Connect. This was part of our core thesis. Last August, we were saying it's coming, it's coming. There were no signs of it, and now it's all come at once. Alibaba's share price has surged since hitting lows last year. That's the front page of the Financial Times. S&P 500 trend channel since October 2022. Low end of the trend channel. Top end is well over 7,000. Commercial C&I loans just starting. Restaurant year-on-year spending growth accelerated month-on-month from 2.5 in July to 3.7 in August. Wait till people start tapping those HELOCs. Producer price changes, we'll cover that. PPI came in a lot lower than expected. That's a lead indicator. The Fed could go 50 bips without blinking an eye, but they won't. They'll do 25. And then they'll have to play catch up later, and hopefully it's not too late. Returns after first Fed cuts. S&P past 12 months after starting of cutting cycles. Earnings growth multiple expansion, 9.6%. Data center power demand is projected to increase 165% by 2030. There's your Comstock. There's your Range Resources. There's your Generac backup C&I generators for the data centers. Weight of tech as a percent of total market. I don't want to be overweight tech here, guys. You're going to get hurt. It's just a matter of when. Maybe it goes up another 3 years. So kudos to you. You gamble and win. But eventually they're going to take you out on the stretcher. Equal weight versus cap weight. This is a level. If you're not a buyer, you're going to miss the boat. You're already seeing it this year. CPI subdued. Okay. So that's the point, ladies and gentlemen. You're here on BABA, breaking out of denial into the parabolic move. You're right down here for PayPal, getting ready to hit denial. And then we'll start to go parabolic by year end of year. Still a lot of stock we can buy in that one, a lot. And then the overlays is going to be the bigger deal. Here's overall index. Barometers that we take a look at each day and each week just to kind of get a feel for where we're at. I'm looking at the option skew. It's getting a little bit elevated, but not at a level where I'd get very, very nervous about a big major sell-off. Paying attention to it, but pretty comfortable with these levels. Option skew, for those of you who haven't been around for a while, basically the cost to insure catastrophic events, 1 and 2 standard deviation moves down, call it 10% plus. Out of the money index puts versus VIX is at the money. Thanks for everyone for the orders, by the way, have been pouring in. I got my hedge fund tips with Tom Hayes hat. And it's really fostered, I believe, a tremendous amount of word of mouth about the podcast. And as I've always said, you keep sharing and we keep growing. We're going to keep doing this for both clients and non-clients. And the easiest way to do that is to wear this, wear some of the gear. People will ask you about it, share, and then send in your pictures, though. We're not getting the amount of orders we're getting relative to the amount of pictures is scant. So please put your picture up, even if you don't want to put your full name up and you just want to put your first name and last initial. Let's show everyone this incredible community and take advantage of that. Okay, some headlines. Alibaba goes big with AI, 3.2 billion, zero coupon convertible bond. They're going all in on AI. I love it up here. Good for them. Alibaba windfall prompts Hong Kong regulators to allow bond-funded buybacks. Love that. Top Chinese and U.S. envoys talks pave the way for Xi-Trump meeting. I mean, you can't write better headlines. Chinese stocks, 90% of U.S. investors set to increase exposure, Morgan Stanley says, after more than doubling. Now they're going to start to get exposure. And then when they've tripled, they'll be all in. And when they've quadrupled, they will be on margin. Alibaba holds wide lead over rivals ByteDance, Huawei, Tencent in China's AI cloud market. The Hangzhou-based giant holds nearly 36% of the market, more than the combined share of its three closest competitors. What else do you want to talk about, ladies and gentlemen? Citi raises Hang Seng Index forecast, citing improved earnings and Beijing support. Alibaba is number one for China traders, plowing $1.7 billion in stock. How you doing? Trump says, what a difference a year makes. Trump says Fed Chair Powell should we always overestimate what we can accomplish in the short term and underestimate what we can accomplish in the long term. Trump says Fed Chair Powell should make big rate cut now. We agree. Employers add nearly 1 million fewer jobs than believed, data shows. Wholesale inflation unexpectedly fell in August, teeing up the Fed for interest rate cut next week. Trump says Hassett, Warsh, and Waller are finalists for Fed chair. The only way Trump could screw this up is to appoint Warsh, in my opinion. I know a lot of people like Warsh because he's an academic and, all that stuff. And I'm sure he's a great guy, but the guy has historically been hawkish, not dovish. And Powell seemed like a cooperative, rational fellow before he became chair, proved to be the exact opposite, completely unqualified for the job, would have made a great Treasury Secretary. Warsh would probably be a great Treasury Secretary, but Besson is great. Maybe, I don't know, maybe Lutnick will get tired, put him in commerce. I don't know, let him run the FAA, but not the Fed. Mortgage demand jumps to the highest level in 3 years as interest rates drop sharply. Early days, ladies and gentlemen. Trump might declare a housing emergency, how he could fix it. The one thing that's in this article that is fascinating to me is they're talking about, he notes that an out-of-the-box solution would be to allow current homeowners with low rates to move with them. The government could use mortgage giants Fannie Mae or Freddie Mac to provide a transfer of a homeowner's 3% pandemic-era rate. That would be an incentive to get them back in the market the way today's 7 rates wouldn't, but comes with a host of other complications. That's interesting. Obviously, opening the federal lands is going to be the core, but that's not something I've heard before. I think it's interesting, and it wouldn't shock me if Trump figured out a way to do it. Blowout 10-year auction, lowest yield since last September, 50 basis point jumbo cut, near record foreign demand. Record EV sales drive auto market ahead of credit, and that's going to be good front loading for Cooper Standard. Legacy car brands launch a product blitz to take the fight to China. By the way, hats off to Tesla and Musk. We picked up Caitlin's car this week, and that is the most seamless, amazing shopping experience of all time. If they do a good job with the new X, we'll probably get another one, and we'll just see what that change looks like. But what an experience. Caitlin is calling me. I can't believe it. This full self-driving. It's unbelievable, blah, blah, blah. It's super, guys. All right. Legacy car brands launch a product blitz to take the fight to China. Intel says 2026 will be a pivotal year for its manufacturing tech. So what they're saying here, Intel will only build 14A manufacturing capacity if it gets commitments from external customers wanting to use it, according to Chief Financial Dave Zizner. So it's basically saying, hey, Trump, congratulations. You got $9 billion of equity in Intel. You don't get as customers, your $9 billion is evaporated. And I think they knew that prior to inking the deal. And I think it's a quid pro quo. And I think there's going to be an awful lot of pressure to push orders into this 14A in 2026. And once that game starts, you got a multi-bagger. It's just a question of how many bags you want. Intel's TAN points new leaders for data center, PC chip groups. This guy's shaking the tree. Boeing steps up jet deliveries, surpassing 2024 total by August. Boeing and union for 3,200 striking workers reached new proposed deal. China plans to sideline lithium competition. Albemarle stock rises. So first, they reopened that mine. The stock fell. Everyone got nervous. We bought shares. And now it's back to what it was a week ago, which is China is controlling the supply, and Albemarle is going to be a huge winner. Here's an interview with Bracken Darrell. We are going to listen here. I'm going to see if I can properly. Here we
tariffs and all the other things we talk about. I feel more confident than ever about what we're doing. So which is kind of ironic.
Well, it's sort of ironic at a time when consumers are supposed to be feeling bad because of tariffs, because of some of the inflationary pressures. Do you feel like consumers are strong enough to absorb some of the price increases that we've heard about?
Yeah, I think they probably are. I also think Doug McMillon, CEO of Walmart, said something, I think it was last week, about the pace at which the tariffs have been filtered in has been slow enough that it's been a little hard to notice. So you didn't walk into the store and see a price change right away, even though the tariffs were talked about the hour before. So I think that's probably helped make it a little more palatable for consumers.
Well, is it making it more palatable for you? Because it might be slow, but they are there. How are you passing them along? Are you passing them along in pricing? Are you passing it along and just absorbing it on your margins?
And we have so much internally that we can work on, from cost to pricing, strategic pricing, that we are very confident we'll offset the tariff impact by sometime next year. And it'll cause a little impact this year, but we're not too worried about it.
How much are you seeing sort of this choiceful, and this word that people use, choiceful or selective, or looking for a deal type of attitude from consumers versus what's cool?
Well, it's interesting. So our promotion levels are down versus a year ago, by the way. And we're in the business of trying to sell things that are cool. So I think it always feels like people are looking for cool things to us. And across our brands, Timberland, the North Face, Vans, all of them are about trying to create cool products with cool marketing. So far, so good. I don't think that people have traded down to choiceful from cool yet.
So are you able to raise prices? Are you planning on raising prices?
Yeah, we will raise prices, but it'll be very selective, and it'll be over time. So it won't be a sudden, turn on the lights, the prices are going up. It'll be very, very strategic, and we're going to follow where the market goes. We're not going to try to lead it.
I will say it is back to school season, and I have kids who are going back to school, and I see you're wearing a Dickies shirt, and I will say they're not wearing Dickies, they're wearing Timberland, and they're wearing North Face and other things. Do you have a favorite brand? I know you can't have a favorite child, but do you have expectations of one brand that potentially will lead growth for the next year or so?
As you said, I've got 3 children, and they're all my favorite. All these brands are my favorite. If you ask me which one am I most excited about from a growth standpoint, I refuse to answer that. But I will say that Ultra, the brand you didn't mention, is a running shoe brand that's absolutely on fire, and it's a tremendous running shoe for off-road, on-road, doesn't matter. We grew 20% last quarter. It's on fire. But I feel really, really good about all of our brands. All 3 of the ones you mentioned, I think they're all going to do well.
What about Vans? Because I remember Vans from when I was in high school, and it hasn't changed much in terms of its reputation, but you've talked about a turnaround plan. What does that turnaround plan look like, and how far into it are you?
Well, it starts with getting great people, and we've got a great leader of our Vans business. She came from Lululemon. She's the head of product. And then it goes back to the basics, which is amazing product. We just have to have more new product out there for consumers. People still, the same people who loved Vans before still love Vans, but they just haven't seen something new from us enough. So we've got a couple of new products that have come. The Super Low Pro is a really low profile shoe. It's selling really well. New School is really doing well, and that is a puffy version of kind of the old school. And then on top of that, we've got some other cool things happening. Like SZA is now our artistic director, if you can imagine that. And she's really, really interesting.
For Vans?
Yeah.
Okay, so this sort of goes to what's cool, what's popular. And there was this sort of androgynous phase, and now we seem to be shifting into something else. What's sort of the latest thing that's catching on?
Well, I think the cool thing about where we are today is that slowly everybody's becoming creative. or maybe we were always creative and getting to be a creative. And so people can be more expressive. So for a while, you'd see one brand of shoes on everybody's feet. Now there's this fragmentation, which is wonderful, and people are making choices. They can be expressive about who they are. I think that's the new world we're in, and I love that world because it is about creativity and self-expression and uniqueness, and every person is unique.
So you have 11 brands now. There's been some brands that you've let go of, some brands that you acquired over the past decades before you even got there. What's next? Are you planning to acquire more? Do you have plans for that? What's your sort of schedule for that?
In the near term, no. In the near term, we're going to bring down our debt levels to bring our leverage down, and we're going to get these big brands growing strongly. So that's really our game plan. So Timberland's already growing, North Face is already growing, we'll get Vans growing again, Ultra's growing fast, Dickies will grow. So that's really our game plan. And then once we get that going, then we'll look at acquiring new things again. But for now, we've got plenty of growth in the existing business.
How much advantage is there to being big right now, especially with the tariffs, with this question of technology and how it gets deployed?
Well, I think the biggest advantage of being big is that you get to learn across multiple places. So we have 11 brands, and we use 11 brands to learn on, 80 countries to learn from, and the ability to feed all that back and upgrade the whole system. That's really the advantage of scale right now, and we're really trying to take full advantage of it.
How much are you seeing AI sort of creep into that also in terms of efficiencies of scale and using algorithmic learning to better process data, to better process sales, et cetera?
I'm seeing it everywhere. We have AI experiments going on in virtually every part of our business. They're all relatively small scale, except one or two today, but they'll keep growing. And they're just major abilities to enable people to be more creative and to leverage scale and enable us to invest back in things that can really drive growth and more product creation things. So I'm very excited about AI over the next 5 to 10 years. I think it's going to transform every business, including ours, and every function of the business.
Do you think that it's going to reduce the employee base?
You know, that's the big question everybody's asking. I think the reality is it will enable every person to do a lot more. And that could be translated into a smaller consumer base, or a smaller employee base, or it could be translated into a bigger revenue base with the same number of employees or more. That's what I want to do. I want a much bigger business. We're all about growth.
You know, one thing that we've heard a lot about is that President Trump's tariffs have sort of soured a lot of consumers around the world on the brand Americana, and that it could lead a lot of countries and people in other countries to not buy U.S. goods or things that are associated with the United States. Have you seen any evidence of that whatsoever?
No, I haven't. And we actually survey China to look for exactly that. And I will say so far, we're not seeing signs of that. There's no boycott America movement of any scale that's emerged. But we're always keeping an eye on that. And the cool thing is that brands are, especially the fashion brands, are often almost seen as independent of country. They almost are their own countries. They almost stand for themselves. And we're a very democratic set of countries because these are small, affordable brands. Not small, but they're affordable brands that everybody can afford, And so I love the North Face, Timberland, Dickies, Vans, all of them for that reason.
Have you changed your supply chains at all in response to all of this?
We've shifted some supply from one country to another one, but generally speaking, the whole industry is hit by the same set of tariffs that affect all the same set of countries where we all manufacture. So it's the most egalitarian impact you could possibly have, which in a way is really good because that means we all are forced to face the same thing. We all got to do the same things, and there'll be variation in how we execute, but in the end, we'll end up at the same place.
Before we go, a lot of people here are trying to sound confident, and I respect that. It seems like everything's been thrown up in the air, especially given all of these policy decisions. You started the conversation saying you're surprised that things are as stable as they are. How much does the court ruling about tariffs change the game? The idea that you don't even know what tariffs are going to come on or what tariffs are going to go off or what the regime is going to be in 6 months.
Look, we have so much opportunity to control our own destiny. We have so many things we can work on without worrying about any of this macro stuff that it really won't matter in the medium term. For us, it won't matter. We've just got to execute. If we execute, I'm not worried about any of that.
Spoken like a true winner. Absolutely focused on what he can control and taking advantage of what he can't. So that's the story there. Healthcare stocks are just starting their resurgence. Hold on to them. There's from Jacob Sonnenschein, fan of the podcast and good, absolute incredible journalist over at Barron's. We couldn't agree with you more. Goldman's Costin says U.S. stock rally set to expand to small caps. No kidding. The rally has legs. Earnings show it. NVIDIA's wow factor is fading. That's at the Wall Street Journal. And our article of the week, don't count the staples out, stock market and sentiment results, playing both sides. A few weeks ago, the Fed finally acknowledged the dual mandate at Jackson Hole and signaled what we have been anticipating for months, the start of an easing cycle. We have long argued that the Fed has been over 100 basis points too restrictive, and the data continues to confirm that view. Last week's ugly jobs report, followed by the largest downward revisions on record to nearly 1 million, and a soft PPI print seem to have locked in a rate cut for next week. The only question is whether it will be 25 or 50 basis points. And as we enter this easing cycle, investors are already tripping over themselves to add exposure exactly where you'd expect. Rate sensitives like housing, discretionary, and small caps are all starting to get bid and see flows return after being left for dead for much of the cycle. We entered the year pounding the table on that exact playbook, albeit at much lower prices, and have since been handsomely rewarded. Whether it's VF Corp, Canada Goose, housing names like Stanley Black & Decker, Generac, QXO, or cyclical autos such as Advanced Auto Parts and Cooper Standard, all are just leaving the station with a long runway ahead. And so you see here the beneficiaries and the table of what does well after a Fed cut. However, what has been completely overlooked in this scramble and where we continue to see generational opportunities is the defensive side of the market. Staples, healthcare, and energy have all been left for dead. While investors seem to be crowding to one side of the boat, we continue to believe that this is not an all or nothing market. This is a regime where both trades can work, and with the rubber band stretched so far against these defensive areas, reversion to the mean becomes inevitable. Here is defensives, staples, energy, healthcare, and utilities relative to the tech, and you can see the inverse relationship at an inflection point now. Cyclical versus defensive flows since the April 8th low. And high dividend yield still cheap and under owned, the cheapest since 2001. We've covered this. This is going to be a core theme for the next 24 months. You're going to see it happening. Dividend yield is neglected by active managers. A key driver of this view is the fact that dividend yield remains cheap and neglected, a trend we expect to reverse quickly as the Fed enters this easing cycle. Once rate cuts begin, the $7.4 trillion sitting on the sidelines earning 4% risk-free will be forced to find yield elsewhere. When that happens, these sleepy, boring dividend pairs will be in high demand, triggering a rotation that brings defensives back into vogue, and we'll be more than happy to help investors get exposure. Two of the names we believe are well positioned to benefit from this rotation and the focus of this week's article are Hormel and Diageo. Can't give these away right now. People will be clamoring for them 2 years from now. Hormel just reported its fastest top-line growth in nearly 3 years, plus 6% year on year. Let me repeat that. Fastest top-line growth in nearly 3 years, 6% year on year, as the protein craze continues to show no signs of slowing. Unfortunately, a steep and unexpected rise in commodity costs caught Hormel offsides, erasing much of that benefit and putting earnings under pressure. Par for the course this earnings season, the market overreacted, sending shares down 13%. We were in the market buying as many shares as we could. And for those who sold us shares in the hole, we thank you for your service. So you can see here, hogs, they do, bacon and all that stuff, live cattle, Hormel, Dinty, beef stew, and feeder cattle has gone parabolic. It's now starting to break down. When these commodities break, like you saw in 2014 and in live and feeder, they don't break down a little, they break down abruptly, and the trend continues for 3 years. That's when you're going to see the restaurant stocks, the Hormels of the world, absolutely go straight up. At the end of the day, Hormel has been compounding wealth since 1891. Not 2021, 1891. They've been doing this for a while, ladies and gentlemen. To think this is the first time it has faced rising input costs over 130 years is laughable. As it has done many times before, Hormel will work through a handful of quarters of margin volatility while passing through costs. Zoom out, and this will be nothing more than a blip on the radar. On top of that, you have a proven CEO, Jeff Ettinger, back at the helm to right the ship through October 2026, with plenty of time to work his magic and position the new CEO to step in as a hero. In the meantime, we'll continue to add shares where we can, collect the 4.5% dividend yield, and growing, by the way, and watch this sleepy name recover. Okay? Under Ettinger last tenure, during 11 years, he had a five-bagger in 11 years. He came in when the stock was $7. He left when the stock was $38. I think he's going to have at least a double, if not a triple. But probably between now and 2026, probably a double. And then the new CEO will take it from there. In the meantime, you get a growing dividend yield, and you get to lock in that dividend yield. And the reason that's important is because they are a dividend aristocrat. So not only are you locking in that yield, but it keeps growing every single year. And when you can lock in a 4.5% dividend yield on Hormel, 10 years from now, you've got a 10% yield on your basis, and you've got a triple stock and a perennial compounder for 130 plus years. So we've highlighted some of the key points. They've had 59 consecutive years of dividend increases, 97 years of dividend payments without interruption. Their dividend yield grows at a 5% compound annual growth rate. So basically every 14 years, the dividend doubles at that pace. So in 14 years, you'd be getting a 9% yield on your basis and growing. So call it, 16 years, your dividend will have doubled. The stock will have probably quadrupled. And your income keeps going up every year above the pace of inflation. It's unbelievable. And people are clamoring to buy T-bills. So they took their sales guidance up from 2.1 billion to 2.15 billion mean. Organic net sales growth up 2 to 3%, operating income growth up 5 to 7%. 10 key points. Organic net sales rose 6% year on year to 3.03 billion, accelerating for the third straight quarter and sharply above Q2's 1% growth. Growth was driven by volume plus 3% and pricing plus 2% and positive performance across all three segments. 2, adjusted operating margins fell 80 basis points year on year to 8.4% as steep run-up in commodity inflation completely eroded the benefits from the strong run-up in top-line growth. Beef costs remain near all-time highs. Pork bellies are up 30%. Wholesale pork up 10%, driving a 400 basis points increase in raw material cost inflation in Q3 alone. Management is implementing targeted pricing actions and evaluating additional measures, with profit recovery expected to lag into next year as cost pressures persist in Q4 and price hikes only partially benefit the upcoming quarter. However, this is not the first time Hormel has faced high commodity prices in its 130-year operating history. They have a track record of successfully passing on costs in the past, and we expect this time will be no different. Number 3, the Transform and Modernize initiative remains on track, delivering results in line with management expectations of 90 projects contributing measurable value and earnings. Management continues to expect incremental benefits for fiscal years 2025 of 100 to 150 million and is currently tracking toward the high end of the range. Retail segment delivered 5% volume growth, 5% net sales growth, and segment profits of negative 4%. Top line strength was broad-based, with 5 of 6 brands posting year-on-year growth. Jennie-O was a standout, up 13% year-on-year, continuing to outpace the broader category and gain market share on top of its number 1 position. Spam also delivered another quarter year-on-year volume and net sales growth. Segment profitability was pressured by input costs, with management expecting profits to begin to recover in 2026 as pricing actions take effect. The food service segment delivered 2% organic volume growth, 7% organic net sales growth, and segment profits down 1% year-on-year. Hormel outpaced the broader industry despite ongoing pressure, including declining restaurant traffic and soft, higher-margin convenience store visits. Premium pepperoni was a standout, posting over 20% volume growth. Management expects the pass-through nature of costs in the food service portfolio to drive a faster recovery of profitability, which is key as the segment typically commands mid-teens operating margin versus high single digits at retail. 6, the international segment delivered 8% volume growth, 6% net sales growth, but its segment profitability fell 13% year on year. Top line strength was driven by thriving Chinese market and positive export results led by the global Spam brand. Profitability was primarily impacted by ongoing competitive pressures in Brazil. 7, Planters, acquired by Hormel in 2021 for $3.35 billion, continues its turnaround, achieving higher year-on-year growth in distribution, household penetration, and turning dollar sales positive by quarter end. With capacity now in place to meet demand, management expects continued sales momentum. On the bottom line, profit recovery is lagging expectations, though Q3 profit did grow, albeit more slowly than top-line gains. 8, management continues to prioritize the company's dividend aristocrat status, returning $159 million to shareholders this quarter alone through dividend payments, bringing total dividends to $474 million through Q3. This marks 59 consecutive years of dividend increases and the 388th consecutive quarterly dividend with a 5-year dividend growth CAGR of 5%. CapEx for the quarter totaled $72 million or 2.4% of net sales, up from $65 million last year. The largest investments remain focused on expanding capacity and optimizing the manufacturing footprint, with management forecasting full-year CapEx of $300 million. And 10, management revised full-year guidance, narrowing net sales to $2.15 billion from $2.1 billion, implying 2 to 3% organic net sales growth due to steep commodity cost increases. Adjusted operating income is now expected at $1.05 to $1.07 billion, with adjusted EPS midpoint reduced to 1.44 from 1.63. Most importantly, management reiterated that long-term algorithm remains intact. 2 to 3% organic net sales growth and 5 to 7% operating income growth. I think that's long-term outlook. Okay. So that's that earnings call we went through. You can read that at your leisure. And now moving on to Diageo here. Still generating $2.7 billion of free cash. Can't give away the stock, except to the brilliant viewers of Hedge Fund Tips with Tom Hayes, who have been taking advantage of this. Now, moving on to Diageo, this is yet another straw hat, buying straw hats in the winter. That's what we like to do, ladies and gentlemen. We buy straw hats when no one wants them in the wintertime, and then when everyone wants them in the summertime, we sell them at double. Shares have been cut in half as if consumers will never drink again. We're more than happy to take the other side of that trade. While consumers may be moderating, the real trend is clear. They are drinking less but drinking better. No company is better positioned to capitalize on this long-term premiumization than Diageo. Diageo is a classic story of cyclical downturns playing out within a long-term secular uptrend, and we expect this cycle to be no different. The number one thing we can look for in a turnaround is free cash flow recovering, and that is already well underway, with management targeting $3 billion of free cash flow for the coming year. In the meantime, as management waits for the inevitable cycle to turn, they continue to focus on what they can control, cutting costs and positioning the company for the next leg of growth. Zoom out a few years and Diageo will be leaner, stronger, and benefiting from margin tailwinds tied to premiumization. It will be growing at a mid-single-digit clip and trading above $200 tomorrow, in our opinion. Again, you're at hedgefundtips.com. Scroll to the top, click on terms. This is all opinion, not advice. Consult with your financial advisor, psychic, guru, magic 8-ball, whatever you need to do before doing anything. Let's go here. Number one thing we look for is free cash flow coming in the meantime. Okay. Mid-single digit clip, trading above 200. Tomorrow's newspaper today. Until then, we sit on our hands and collect our 4% dividend and wait. Top 10 points. Number one, organic net sales rose 1.7% ahead of street consensus of 1.4, driven by 0.9% volume growth and 0.8 price mix growth. Management noted that the tariff-driven pull forward behind last quarter's 5.9% year-on-year growth has largely cycled through, with inventory levels now normalized. Number two, Diageo gained or maintained share in 65% of total net sales across measured markets, including the US, and delivered organic growth in 4 of 5 regions. Sales rose 1.5% in North America, 9.2% in Latin America and Caribbean. If you remember, that's where they had all the problems when the stock tanked. So that's now recovering, 0.3% in Europe, 10.5% in Africa, while Asia Pacific declined 3.2% on weaker China and travel retail. I can tell you one thing, in Africa, where they've got 10.5% growth, they're not worried about Ozempic and they're not worried about 0 calorie, 0 alcohol Diageo. They're selling the real stuff and they're selling it by the boatload. 3, Guinness remained a standout during the quarter, delivering 13% organic net sales growth and gaining share in its top 3 markets, Great Britain, Ireland, and the US. Guinness 0.0 continues to expand, driving 40% growth in Diageo's non-alcoholic portfolio, where the company leads the market at 4 times the size of its nearest competitor. Don Julio was another highlight, up 38% organically and gaining share in 90% plus of measured markets. Number 4, management raised its cost savings target under the Accelerate program to $625 million from $500 million over 3 years. 50% of the savings are expected to flow through to the bottom line, supporting mid-single-digit organic operating profit growth for fiscal year 2026 and sustaining a 29% sector-leading EBIT margin, with the remainder reinvested for growth. Diageo generated $2.75 billion in free cash flow for the year, up $139 million year-on-year. Improving cash flow remains a top priority for management, with guidance for at least $3 billion annually starting in 2026, which includes a one-time Accelerate program cost with upside potential as the business recover. At current prices, this implies free cash flow yield of at least 5%. 6, cleaning up the balance sheet remains a top priority, with Diageo ending the quarter with $21.9 billion in net debt and 3.4 times net leverage ratio, in line with prior guidance of 3.3 to 3.5. Management remains on track to hit 2.5 to 3 times net debt to EBITDA target by fiscal year 2028 at the latest. 7, 75% of Diageo's business is unaffected by U.S. tariffs, with most products exempt under USMCA. Management expects a $200 million annualized operating profit hit, but aims to mitigate 50% in year 1 before broader tariff-specific pricing actions. 8, management expects CapEx of $1.2 to $1.3 billion for the coming year, down from $1.5 in fiscal year 2025, as they continue to focus on improving return on invested capital and higher growth opportunities. Over the next 3 years, CapEx is projected to decline to a mid-single-digit % of net sales versus 7.7 in fiscal year 2025. 9, Diageo has a track record of active portfolio management and remains committed to pursuing disposals of non-core assets. However, despite earlier rumors, management has no plans to sell Guinness or its stake in Moet Hennessy at this time. 10, for fiscal year 2026, management expects organic net sales growth near fiscal 2025 levels, negative one, which is 1.7%, with slightly negative first half and accelerating second half, which would imply organic sales growth in the 4% range. They anticipate a return to positive operating leverage as cost savings kick in, driving mid-single-digit organic profit growth, which includes the current impact of tariffs. So that's the story there. You can read all the key highlights from the earnings call. Fear and greed is at neutral levels. National Association of Active Investment Managers, a little fear in there. And then congratulations to all of our new clients that came in intra-quarter Q3 with our larger sized accounts, and to those existing clients who upsized and in many cases dramatically upsized their contributions to their accounts. We will reopen to smaller accounts, $1 million plus, starting now. Okay, those interested in going live on October 1st can begin the onboarding and application process ahead of time. For those of you who've dealt with Interactive Brokers, it takes a little while to get approved, so you want to get ahead of the curve. And to see if you qualify to take advantage of this opening, you can click here, go to hedgefundtips.com, click on money management. Not a solicitation. All of this is opinion, not advice. See terms. And by the way, I just want to apologize for dropping the ball. I've handed over my inboxes to my assistant, who has found way more than I would have liked to see of people who have reached out to invest and not been contacted. To those of you who that has been the case, we apologize. We are getting back to you one by one, and we will make sure that's not an issue moving forward, because Jennifer's the best, and this stuff will not slip through the cracks. Our priorities remain, number one, getting our existing clients the best possible returns. We've succeeded on that front. Number two, taking in those larger accounts whenever they want to come in. We offer bespoke service. And number three, making available for the small accounts, the $1 million plus once a quarter, to bring them in all at once and help them take advantage of what we're doing here. And that's what we're doing right now. So we're grateful for all categories and the continued votes of confidence from those that we've delivered for massively, who have massively added to their accounts. We're very grateful on that front as well. And it's quite a few of you. So financials, earnings estimates and revisions, top 30 weights in the last 60 days, up for 2026 in 1.66%. Note to Jeff, we can stop doing 2025 because now we're in fourth quarter, basically, or coming up on it. Everything's going to look forward to 2026. Healthcare, top 30 weights, revised down 2.44%. That's why people are so bearish on it. The biggest downward revisions have been the insurers like Elevance, Cigna, UNH, and then a few drug companies. But for the most part, on a company by company basis, most of them have been revised up. PPI, as we discussed, was expected to come in at 3.3%, came in at 2.6%. That's a preview of coming attractions. They might be late with these cuts, but if they get caught up quickly, it'll be fine. You can see earnings are now back over, not only at 300, but remember, they got down to like 293 for next year. They're now at 303, and that's a big deal. So with that said, we're going to move on to the Ask Me Anything questions. We got quite a few from our incredible audience of viewers. Goran, I watch your Goran Stoisic. Hey, Tom, watch your appearance and especially the pod, the most valuable financial show on the planet. Thank you. I'm aware of your position in Chinese equities, ex-Baba, but please hear me out. Raging bull market in China, da-da-da-da. BEKE. Such a reason, BEK is cream of the crop. Look, man, you want to dance with the devil, you might win. But just know you can do all the work in the world and wind up with an empty bag. Obviously, this looks beautiful technically. It's probably going to rise. I mean, look, if you want to play with fire, just get out before the building is on fire. But financially, I'm sure this is going to look incredible. But it's not a national champion like Alibaba. So if BK or BEKE blew up tomorrow, no one would give a shit, and that concerns me. So if Baba was destroyed tomorrow, so would Xi Jinping be destroyed tomorrow, and he would be out of office. So I'm not taking company and country risk. And, look, we're in a bull market, so everyone's going to get excited about all these names, and they're going to make money in them for a while because it's early stages of the bull market. I'm not going to be one of them. I got all my eggs in a basket with a lot of outs. That's made me a unbelievable amount of money now. And on the options, like insane amounts of money. And because we've done it, we've had like multiple bites of the apple at that over the last couple of years. And now it's going to make me an insane amount of money also on the stock. And that's going to take, we're just excited. Okay. Revenues look good. Share count got a little out of control. They reined it back in. It's not it's not generating a good return on capital for owners, so I don't like that. Let's take a look at the balance sheet. I'm sure it's fine. $7 billion of cash, basically zero debt. Generates $1 billion of cash. Yeah, look, again, I mean, yes, but it's China, and people are going to forget that this cycle, and there's going to be a lot of new paper issued, and people are going to get burned. But that's 3 years from now. So if you want to, when the music's playing, you got to get up and dance. You can probably get away with this one for a couple years and double or triple your money. But the hell do they do here? Housing transactions and services. So housing coming back. It's probably early for that bet, but look, I think you're fine, Goran, but I'm not taking that gamble with you, even though I think it'll probably work for you. Rule number one look, here's the bottom line, Goran. If JP Morgan were going to finance you to buy the entire business, they were going to give you debt financing to buy 100% of BEKE, with the only caveat is you had to put 100% of your net worth as the equity slug. So if it worked, you would make not double or triple your money, but 10 or 20x your money. But if it didn't work, JP Morgan gets the business, you get wiped out, hole in the donut, you go become a greeter at Walmart. Would you do the deal? And if the answer is yes, and you've done enough work that you would risk everything on it because you think you're going to make 20x, then you should buy one share. If you don't feel that way and you're just like, China's going up, so where can I gamble and hope that it goes up with China? Have at it. But, eventually you're going to get taken out on a stretcher. Maybe not from BK, it'll be the next one. And BK, you'll 10x your money and you'll say, I'm so brilliant because, I saw China was going up and I bought a leverage play and I gambled and won. And then you're going to say, because I'm so brilliant, I'm going to gamble and win again. But you're not going to call it gambling. You're going to say, I'm a sophisticated investor. That's old school. They make doubles and triples. I'm new school. I make 8-baggers. And you're going to put the whole damn thing in and you're going to get wiped. And I'm going to be waving to you, not when I walk into Walmart, when I drive by Walmart, because I don't walk into Walmart. So that's all I have to tell you. Your analysis is fine, but it's China. And you got to understand it's a different game. And you haven't been long enough to realize that. So dance while the music stops, but you better be damn right when the music is ending. It's not yet, it's not near, but it's coming in a matter of years. And it'll probably be the last time they turn on the music for a long time in China, by the way. This is the last cycle. They're too old, but they got one unbelievable 3 to 4 year cycle. Inspire, turnaround in healthcare. This looks pretty interesting. This is from Paul Hauk. Paul Hauk. Paul's been with us for a long time. I watch his comments. I see all your comments and your hearts and your all that stuff. And I see it. I appreciate it. I remember it. I'm grateful for it. And talk about a broken growth stock. This one's going to take a long time to rebuild an institutional shareholder base. Okay, so this is a tiny company that's gone from losing money. Oh, sorry, this is the cash flow statement. Let's see what it's doing on cash flow. All right, yeah, it's gone from burning cash to now huge inflection. Revenues are growing. Shares outstanding are growing, but not insanely. On face value, I like this a lot, Paul. 445, no debt. Okay, so what do they do? Medical technology company, development and commercialization of minimally invasive solutions for patients with obstructive sleep apnea. Provides safe treatment for moderate and severe Nerve stimulating, maintain open airway. Yeah, so I think the name of the game is, what's their moat? How do they maintain their moat? What's their competition? Looks like things are going in the right direction, but you're making a binary bet here. And you're kind of having to predict the future, which I don't love, but I think you probably have a decent enough margin of safety. It's worth doing more research, but you really better understand everything about the competition and the moat, and talk to doctors, do channel checks, find out why there's nothing else like this, because, this thing is in the early stages of breakdown. Even though the fundamentals are improving, it kind of reminds me of Amazon in 2000 to 2002, when the fundamentals were improving, but it was a broken growth stock, and the stock fell 90% before, it went on to do all the great things that it did. I think this one I'd probably explore again in the 60s or 50s. May never get it, but in the meantime, do your work, be patient, and wait for an opportunity. I still think it's a little early, even though it's down 70 something, 75%, 90%. I'd be more interested. But good one. That's on the watch list for sure. Alexandre French. New to the podcast and love it. Well, thank you. Welcome, Alexandre. Corvell, CRVL. CRVL. How about Carvel? We'll have some soft serve. I mean, this thing is barely off its highs. This looks like a long-term compounder. This is not what we do. We look for massive dislocation. This is nowhere near that. So for this one, it's not for us, but I'll just take a look at it. Maybe you want to own it as a long-term compounder and go to the beach. Seems to be reasonably positioned to do that. No debt, plenty of cash, generating cash. Great income statement. Growing revenues again. Share count steady. This looks pretty okay. Let's see what the hell they do. Provides workers' comp. Oh, I hate workers' comp. General and auto liability, that's great. Hospital bill auditing, payment integrity solutions, AI. Is it care related to healthcare costs? Yeah, bring it back up if it gets down to like $50, but this is not, it's just not, there's higher and better uses of my money. I think your analysis is sound, and I think the idea is okay, and it probably works over time, but I need doubles or triples in a few years, and this is not going to be one of them. Max M, freshman studying finance, wondering if you had any advice on what to look for in internships. Anyone that'll take you, if they make you, depends where you go to school. If you're at a great school, the internships come to you. If you're at a bad school, you got to go get the internships, and you basically just say, I'll make your coffee, I'll do whatever you say, I'm a hard worker, and hopefully someone gives you a break. And you hustle and you get it. You get your foot in the door. You do great things. You exceed expectations. First one to arrive, last one to leave. And good things will happen. Do more than you're paid for as an investment in your future. And sooner or later, the equation flips where you're getting paid more than you're worth. But that takes years, not days or months. Al Rudell. ANF, I have zero interest in this stock. This is a broken 10 bagger. this is where people get hurt, because they buy newly broken shiny objects and they catch the falling knife at the exact wrong time. Everything looks fine. This is a broken stock. I would not be interested in this at the moment. Let's move on. But thank you for the question. York Bourgeois, hope your week's been going great. That's the understatement of the century. If an early April Liberation Day situation came again, most everything went on sale, only this time you wanted to set up long-term cash vehicle like Buffett did. What are some examples of companies you would buy? That's like predicting the future. It's not even predicting the future. Look, you're dealt a hand and you play the hand to the best of your ability. And the best of your ability is based on experience, cycles, education, constant learning. And you can act very quickly because you've compiled 20 years of knowledge of understanding companies. So you can't predict it before it happens, because each mini crisis is going to, October 2022, your mini crisis created opportunities in Google and Amazon that created quick doubles. April was different. It was companies that were hit by tariffs created quick opportunities. So you just have to be flexible and see what's getting hammered and why, and is it a temporary issue or a permanent impairment? And more often than not, it's temporary, but you have to do the work. And you buy the highest quality in the most dislocated sectors, and you make fortunes. And rinse and repeat over and over. But good question, York. But you can't answer that until you know the quote-unquote cause of the next dislocation. Constellation Brands. This is from Eduardo Gonzalez. This is in the basket of Diageo. I think they're all going to work, but I think Diageo is going to be the highest and best use of capital. I would be less focused on companies that have a lot of beer exposure, like Corona, Modelo. I mean, that's huge in Mexico, obviously, but I'd be more in the high-end, high-margin spirits. So that's that our play is Diageo in that space. Stephen Lasday. I'll get back to you on that. Another investor looking to come in. All right, Lars Lund. Have you found your pick in the chemicals massacre? He's looking at EMN. We have enough exposure, but you'll know when you know. Let's just put it that way. Eastman's fine. We've covered it a couple times. It's not super dislocated, so we wouldn't be in this one, but this one will be fine long term. I don't think there's enough dislocation in this relative to the fundamental erosion for me to be interested in that. There are much better players in that space, but we've made no announcements on that. Stephen Lasday. Oh, we covered that. Okay, here's another person who wants to be my video producer. I got Stephen. He's doing great, but thank you. Can you do a buy analysis on Troy Aikman? Troy, we've already covered National Oil Well Varco, and we'll probably write that one up again in coming weeks. LBRT. We not only own that, so welcome to the podcast. We own Varco. We've talked about Varco. We've covered it in articles. Go back and look. LBRT. Hydraulic fracking services. I mean, why would you buy this when you could buy Schlumberger or Halliburton or National Oil Well Varco? You don't need to own 6 of them. Pick the best and buy it. I would buy, if you're going to buy services, as far as value per dollar, I think it's Varco. I don't think it's Liberty Energy. Let me just see here. Got 20 million of cash and 190 million of debt. And, you know, free cash flow is starting to crank. Revenues are down a little bit, but that's no problem. It's cyclical. They issued a ton of stock in the last few years. This is not for me. I don't like these type of people that issue a ton of stock at the wrong time. Daryl, Daryl, okay. Enjoy listening to your show every week. Someone inquired about Starbucks. Are you still a buyer? You said you'd be a buyer at $80. Let's see. Daryl, I said, I don't think I said 80. I think I said 60, but I don't think I'm going to get 60. I mean, look, here's a stock that's off 20, 30%. I'm not like, that doesn't excite me. I don't think Starbucks is going to $200 anytime soon. So if I can't double my money in 3 years, I'm not going to commit $1. Like if you want, you know, dividend yielder with Brian McNichol, he's a brilliant CEO. You know, you can have $80 go to $130 in 3 years. That's great. But this is a snooze fest for me. Great CEO, great company, not enough dislocation. If it got down to like 50 or 60, which it won't. Look, the other thing that's going to happen is commodity prices are coming down for coffee. Okay. Coffee is here. We'll just cover this for you real quick. Okay. So here's coffee. This is the same story as Hormel and every single restaurant that's getting margins killed by live cattle and feeder cattle. So in the case of Starbucks, here's your coffee chart. Here is your weekly. Here is your monthly. Okay, so here's where we are. We are at near record all-time high coffee prices, which is a margin compression environment for Starbucks. This looks very much like 2011. You get your top, you get your retest, and then you collapse for the next 3 or 4 years. As you collapse for the next 3 or 4 years, you can see what happened to Starbucks from 2011 to 2014. I don't even have to look at the chart to see what happened. And what you're going to find is 2011 to 2014, the stock went from $10 to $50, 4 baggers. So yeah, I think your timing is right. I just don't think you're going to get the multi-bags that I need to commit $1 of capital. But if you want a safe stock that's marked down a few pennies that you can get on a half a sale, then that's fine. Joe Makos, your dad turned me on to your podcast. Trade Desk. Well, thank you for joining, and you have a very smart dad. We've covered this one a few times, and I've continued to say no. I think this is, you know, you've got a broken growth stock is what you have, and you know, you have to be damn sure that their moat is impenetrable against the likes of Amazon and Google. Their revenues and free cash flow keep growing. Their margins are compressing a little bit. This one has been a pass for me. I think it's going to continue to be a pass for me. I think it's very hard to understand how they maintain the moat. And I'm willing to be completely wrong. This would be an error of omission, not commission. I understand it looks cheap, but for me, when these type of things break, they tend to take an awful long time to build a new shareholder base. So I'm going to pass. Caesars, CZR. Interesting. My guess is they have a lot of debt to refinance yet again, like every cycle with these casinos. Revenues have been flat following COVID. Free cash flow is just barely positive. Let's see here. Revenues declining a little bit year on year. They doubled the share count in 2020 to 2021. They must have done a big acquisition. Yeah, and look what happened to shareholder value, dropped 80%. Free cash flow negative big time last year. Let's see about quarterly. Yeah, start to come back. So you got $860 million of cash. You have $12 billion of debt. That's a big problem. Yeah, if you're barely free cash flow positive and you got $12 billion of debt that you have to refinance, they might get bailed out by the easing cycle, but that's not an ideal scenario. Let's see what they bought. Maybe they explained it to us here. Yeah, I would really have to study the capital structure and see when all this debt matures. I think you're in the ballpark. P.S. Are you a Ducks fan now that you're in the OC? Hell no. Devils fan, always have been, always will. Rangers fans, suck it. On to the next question. Michael Costa. For a stock to look at, curious on your opinion of Lulu. Lulu is like Starbucks and Nike. Great business, down on its luck. You know, I continue to channel check this stuff. So actually, my assistant helped me understand what's going on in terms of culturally with it. I think Lulu's going to be fine. I'd never really understood the moat. Well, I did. Look, I get it, but this one's hard because the CEO was a hard charger. It's kind of like when the Under Armour was run by the founder and the thing just took off. He was hungry. Then he started buying vineyards and doing all this bullshit with horses and took his eye off the ball. It's kind of same as Lulu. The top design person went to Vans. I am so tempted by this one, and I'm not going to do anything because I don't want overlapping correlated bets, and I've already got VF, and that for me is a huge winner. So for that reason, I'm going to pass, but just look at some numbers here. Free cash flow is great. Revenues are still growing. Shares outstanding, fine. Good return on capital. Balance sheet. Great. I don't know. I think I don't think you're going to get really hurt buying this at this level. I don't think you can be certain, but I think it's pretty close to the level where you really want to be a buyer of this. I would do some channel checks and really understand what's happening, because there were some issues about what it does to hormones, and like some stupid stuff was said. Cultural mishaps that they did. So you got to make an assessment with whether that's temporary or permanent. In the case of Bud Light, the reverse version of this, it was kind of a permanent impairment, but most of the others have been temporary. I think this one is going to be pretty good from these levels, but it's not a pound the table one where I can make multi-bags. I don't think they're going to be multi-bags. You may get a bag or a bag and a half if everything goes great. And that's why I prefer VF Corp. Good question. The answer is, I think you're right. Edgard, Abreu. Lulu, we just covered UPS. I agree. And I'm not doing anything with it yet. And I'm going to be okay missing it. But I definitely like UPS. And I definitely have an eye on it. Michael Costa, can we look at opportunities and potential market reactions for the September Fed meeting and maybe fall season volatility? Also, maybe even talk about potential hedging strategies if it's needed. No, I think, number one, any volatility is going to be short term, and you wind up just wasting 1% to 2% of equity just so you can have a short term mark to market benefit. It's a waste of time. This year, it's not always a waste of time, but in this year, I think it is. I think, we've been able to raise millions and millions of capital just with the 5, 6, and soon to be 7x in some of our options positions. So we've got a lot of cash now that we're not needing. This is cash we can put to work right away in certain names tomorrow, and we will. And we'll have some cash. I don't think you're going to get. A lot of people missed April, so they're hoping September. They were hoping September or early October would be the April again because of recency bias, and I think they're going to be wrong. I think the market pushes too much higher. Not much higher. I think the market pushes higher into year end is what I'm trying to say, and it may be masked. Maybe the indices don't do so much better, but I think there are going to be a lot of names that do really well. So if we're not buying PayPal at $66 because we think, or Baxter or some of the others, or Hormel, because we think that the indices, which is basically Mag 7, might stumble a little bit, I think we're making a huge mistake, because if those stumble, the defensives are going to get bid. So there are things to do right now, irrespective of the Fed, irrespective of volatility. I don't want to miss buying a PayPal or others that we're in the market aggressively on in the last few days, because I'm guessing about whether the index might correct 3% or 6% or not at all, or just keep moving higher. The reason we took a lot of profits on the options is because we're basically at or near the max value. If you can get 5.5 or 6x now, and your max possible value of the spread is 7x, and you got to wait 3 months and everything has to happen perfectly for one more turn, you take some off. And yeah, we'll get some that'll be 7x, the full 7x, but not all, and world's smallest violin. Elliot Simmons. He's asking me about Chipotle Mexican Grill. Is there a multiple I'd like that? I don't think I ever look at multiples. I look at free cash flow. No. It's nowhere. Like at $30, I would take a look. It's very unlikely it gets to $30. I mean, here's a stock that went up 14x in 7 years. And now it's pulled back a little bit and people want to jump on the train. You can jump on the train. It's a great business. I'd rather if I'm going to be in restaurants, I want bigger upside than a 50% move. Because the restaurant business is a tough business. And when these type of things break, it can take a little while to repair, and it might be indicative of other things going on. But long term, I would 100% bet on Chipotle and Scott Boatwright. And I know a lot of these people live here. Great business, great company, great leadership. For me, I need to see massive dislocation in price for me to allocate $1. And this is a pullback. And for me, I don't get enough bags by buying at this level. And for this quality of a business, I'm probably never going to get an opportunity to buy when there's massive dislocation. So for me, it's a pass, but I generally think the business is great and it's going to continue to grow. Here's another investor inquiry. I will get back to you. Thank you so much. Elliot. Another one. Yeah, again, Scott Boatwright is great. The company's great. Everything's great. It's just I can't make a double or triple in the next 2 or 3 years, so I'm not going to put any capital there. Marco. Staltari. All right, so this guy wants to play robots through a plastic company or something. Let's take a look. I don't know what this is. I don't even have a ticker. If this is like China, send me a ticker because it's not coming up anywhere. So, Conagra Brands. This is a similar story to Hormel. This one hasn't come down enough for me to get interested, so I'm going to pass. I need multi-bags. Otherwise, like I'm not interested in 50% in 3 years. That doesn't move the needle. Nikolai Johnson. T-Tech again. No, we're not going to get involved in that one. I'm sure it's fine. There's no way to really understand the moat there, but it's probably good. All right, so here's TJ Vandermeer. Thanks for the podcast. Great value sharing in Europe. Thank you for that. A couple of years, been investing. Great results. Baba, Cooper Standard. What would you do? You know what to do. Own great businesses and sit on your hands. You already listed all the names. I mean, yeah, tune in, buy them, sit on your hands. That's what you do. check with your consultant first. Thoughts on Tim asked about Constellation again. We covered that. Jimmy Jones, Target getting close to consideration. Yes. Am I going to do anything about it? Probably not, but maybe. New CEO is fine. Brendan Garvey. Okay, so this guy's saying, I'm in college. My professor is a big poster boy for passive investing. Efficient market theory is written on his forehead. What's something you'd say to this professor to throw him off his skates and prove that outperforming is doing? Just show him your results. I mean, if you're following what we're doing, you should be up at least 3 times the index, and just show them your statements. That's all you need to do. But you're not going to convince someone like that. They're that their whole livelihood depends on espousing that bullshit and brainwashing you that that's the only way to go. And statistically, he's right, because there's only going to be a very few number of people that can do what we do here, and that's why you tune in every week. So if he thinks the majority underperform, he's absolutely correct, and he's part of the majority, and he'll continue to underperform, or buy an index and perform in line, or buy a closet indexer and perform in line minus fees. But that's not what we do here. We do private equity in public markets. We underwrite the whole business as if we were buying the whole thing, and we don't buy shares for the sake of buying shares because of some headline or some trend or some flavor of the month. Scott's Miracle Grow. Yep, like it. By the way, don't send in more than one question a week. It's kind of selfish for other people. Lachlan Neo, love your podcast. Well done on the amazing results. Thoughts on Porsche? No, we don't buy warring factions. We buy arms dealers. Lee Foster, how do you feel about Buffett's comments on the Kraft Heinz demerger? Look, they screwed up. I mean, he got seduced by 5G's zero cost bullshit, and it didn't work. So now they're in desperation, they got to do something. The brands, look, they've spent 10 years working day and night to destroy 2 great brands. They couldn't do it. So now they're going to split them up. They're going to get 2 CEOs that are going to work full-time trying to destroy the brands, but they won't be able to do it because the brands are so good. So the answer to your question is Buffett out will remove the overhang on the stock. Heinz will be fine. Kraft will be fine. Oscar Mayer will be fine. They'll figure it out. And we'll look at it when it's separated. But all in, I think that's going to be okay. Tom Barr Forterra. Healthcare exposure. Picks and shovels. FTRE. Negative free cash flow. I'm going to pass. Next. John Reggio asking about Pool Corp. I think you'll be okay with this one. I've looked at it. I don't think I'm going to do anything with it. But yeah, you just want to make sure this trend is actually reversing. And so far, it's not showing signs of it yet, but on balance, this is a long-term compounder. Let's take a look at the balance sheet first. $79 million. Oh, this is your problem. You got $79 million of cash. What are the receivables? 314. Okay, so they can borrow against that, I guess. 900 million of debt. They've paid down some. Revenues are still not recovering. Let's see quarterly. Okay, they're up year on year. That's good. Shares outstanding, okay. I think you're generally okay here. I don't think there's a quick double in it, John, but I think you're generally okay. Pool Corp. Keep it on the watch list. Good job. Jason, Resi, Honeywell spinoff. Oh, wrangled up a few last minute votes for your future Olympian. Thank you very much. By the way, if you want to, this thing is like the never ending contest. She's in the quarterfinals now. If you want to vote for Annabelle each week, I think they email you. Just do the free votes. I know they have this thing where you can pay for votes. Don't do that. You'll see that once we post this video cast, we'll put the link here. If you want to vote for Annabelle Hayes for Youth Athlete of the Year, please submit your vote there. Every free vote here, every single vote matters. We are very grateful. We know a lot of you have been getting the emails and voting every single week, and we are grateful for that. She is working hard and going to have an incredible season. So let's take a look at Rezi, R-E-Z-I. This thing is already breaking out, Jason. Hey, Jason, why weren't you bringing this to me when no one wanted it at 15? You've been around for a while. You should know that. Yeah, nothing not to really love here. Revenue's growing, free cash flow's growing, balance sheet I'm sure is fine. But I don't buy up, so enjoy. I will not be jumping on this bandwagon, but it looks like you have a pretty decent business here, but I would not be a buyer up. Next, Eric F. Again, Lulu, it's fine. It's just I'm not going to get a quick double. What level would you be a buyer of Cat? It's not going to get to a level that I'd be a buyer. I'd probably be a buyer around 150 or 140, and it's not getting there anytime soon. So I don't buy things that are way up, a couple standard deviations above the long-term mean. Don't do it. I sell at these levels. Gasper Mohoric, thanks for the amazing content. Western Union, I get asked every week. I'm not interested. Agri Realty is a low quality REIT, I think. GREE. Someone is pushing the shit out of Western Union on social media or something. I get this question every week. Agri, I have no interest at these levels. Western Union, I know they're doing a turnaround and everyone's excited. I'm not interested in this stock at all. That's a trade. If you want to take it for the trade, you probably make a few bucks. LRN. Stride Inc. Okay, so you're giving me a stock that's up 25x. No, thank you. Welcome to the podcast, Wesley. Hang around. You're going to learn a lot. That is the antithesis of what we do here. Insights on American Axle. It's a completely different business. I mean, this has just been in secular decline. They didn't even make money when the cycle, like they didn't even have a huge run when the cycle was hot. This is not one we want to be involved in. Philippe Pincos, that doesn't mean it's not going to bounce with the cycle, but it's just Cooper is a better deal. FMC, that's from Philippe Andrew Pincos, who has been a longtime supporter. FMC. Yeah, I like FMC. Let's take a look here. This is a ag play and chemicals. Trying to turn the corner, not doing it yet, but when these turn, they turn really aggressively in this sector. You know, the issue is everyone's looking for a cookie cutter, and the only cookie cutter is 20 or 25 years of experience and understanding what are the exceptions in each sector, each company, and the only way you can get that is through a lot of experience. $3 billion of debt, 350 million, but they got 3 billion of receivables. Revenues are down a lot, but everyone in this sector is. Shares outstanding, okay. It's 600 million of free cash flow last year. Quarterly looks okay. Well, wait, what the hell? Sorry. Quarterly looks really good, actually. Yeah, I think this one's going to be fine. I actually really like it here. Crop protection solutions to farmers in Latin America and North America, including insecticides, herbicides, fungicides, biologics, crop nutrition, seed treatment plants, wide range of insects, disease, for pest control. FMC Corporation was founded in 1883. God, I love businesses like this. I really like this. I have liked it. I continue to watch it. Eventually, now that we've got some cash, we'll see. One step at a time. All right. We got a lot of questions this week, huh? Amazing audience. Apache is fine. I like Comstock better, but that's fine. That's from Theo Dujardin. And lastly, that's it. So with that said, we'll be back next week. Same time, same place. In the meantime, make it a great one. Bye for now.